Come back, you would have seen the numbers released by Statistics South Africa this morning. Our economy growing by just 0.1% in the last quarter of last year. Our economy grew overall last year by 0.6%. In other words, we're not in a recession, but if you look at how our population is growing, we're really going backwards. Sifiso Skenjana is economist and MD at ESG Analytics. Sifiso, good afternoon to you. I'm sure somewhere someone is breathing a sigh of relief that we've missed a recession, but we're really not growing at all, are we? I mean, we are really going backwards.
Good afternoon, Stephen, and of course, good afternoon to the viewers as well. Yeah, I mean, I think if you first just take a global view around the state of the global economy, we've seen the likes of the UK going into recession. Germany is also in tatters. The US, I mean, they're still fighting that they are in recession, but they are in recession. If you look at what we often talk about as the inversion of the yield curves, in essence, when investors demand more in buying short-term bonds than long-term bonds, that's often, it's been a predictor of the last 8 recessions. In terms of really, I think, the state of the global economy. You bring it into South Africa's context, I think nothing's different. There's nothing inherently, I think, showing signs of health in the context of our economy. And so certainly I think this number is informed by a number of things. I think there is a base effect context that's coming in here. So you've got sectors, I think, that were coming off a low base, and so the percentage increase looks impressive. But also I think there are a lot of numbers there that are hidden in clusters called miscellaneous. And I think that's where really I think a lot of the detail is getting lost as well. So certainly I think nothing entirely exciting about this GDP read.
We keep being told that load shedding will come to an end. I mean, Sifiso, you and I have been told that for a long time. We're told now that government is fixing Transnet. We fix those two problems. How significant would that be?
Well, I mean, just look at the basket in terms of our GDP contributions. You've got financial services contributing 24% of GDP in terms of the overall value added. The other half is coming from, from government services as well. And so 50% of what comes out from a gross value added is only coming from financial services and government services as well. And that's really telling you around, kind of where the center of concentration is. And so whether we are talking then about productivity that is lost in the services sector from a load shedding point of view, etc., I don't think that the marginal contribution will inform that bigger blip when we are then looking at the relative contributions at that sector level. When you look at the sectors that did perform well in this GDP read, transport coming in there as well, again, when you look at the context of that, there is a base effect, but relative contribution of transport to the broader basket is 8%. And so that kind of increase cannot materially, I think, shift the print or the read in terms of how we see our GDP. Also because household consumption contributes about 59% of the overall GDP basket in the way in which we read it. And of course, when we're seeing what's happening in terms of even the transport contribution from the household contribution point of view, those are some of the things that really, I think, need us to look beneath the hood in trying to get into the detail. But so, yes, transport has a meaningful impact in terms of moving goods and services in our economy. Electricity availability has also got that impact. But I think we really need to take a more balanced and more holistic view in the structural composition of our economy. And therefore, then, when there is, for example, a 10% or drop in megawatts available, how does that actually impact some of the sectors? And that's some of the modeling that we're currently busy with.
Sifiso, quickly if you can, difficult though. Interest rates, we are expecting interest rate cuts. Some people say up to 4 rate cuts this year. I know the National Treasury may look at changing the mandate of the Reserve Bank on that to lower the inflation target. But if we get cuts to interest rates, will that make a big difference?
Yeah, I mean, so petrol contributes to about 25% in terms of what we get into our inflation basket. That's not coming back anytime soon. So I think the outlook on inflation, I think at this point in time, is to the upside. There is a revision that is happening on the PPI basket, the Producer Purchasing Index. And therefore, again, that's also going to bring in a lot of the food components coming in. And therefore, I think the suggestion is that we're not probably going to see that many of those cuts coming through. But if we did see those cuts, I think it will certainly improve household health from a credit exposure point of view, as well as, of course, cost of acquisition for some of the capital goods that relapse of the manufacturing as well. So it does have an impact. But of course, the Reserve Bank governor did tell us that it often takes about 18 months for the transmission mechanism to kick into the economy when there is an interest rate cut. So we wouldn't expect to see that coming through anytime soon.
Sifiso Skenjana, thank you. Economist and MD at ESG Analytics. Really do appreciate the time.